Okay, so let's have a look at the second adjustment for a Melba 2015 company question. So patents incorporate 4 months investment income are to be written off over a 5-year period. So for some reason, we've put 4 months investment income into our patents. It shouldn't be on patents, it should be on investment income. So anytime you get this adjustment, there's going to be 4 steps you're going to do. So you're going to find out how much the investment income is for the year. So you're going to go to the trial balance, find your investment, multiply it by the rate, and then see how many months we have it for. I usually do my investment income due here, keep it together. So you want to find out how much is due because we've put some into our patents. So that's going to reduce the investment income up here. We're going to recalculate what our patents are. So we need to take our investment income out of our patents by adding it on, and I'll explain that to you in a second. And then we're going to calculate the patents written off. So there's 4 workings we're going to do when we get our patents. Your investment income, that goes to add operating income. Your investment income due in your balance sheet as a current asset. Your patents in your balance sheet as an intangible asset. And your patents written off in your profit and loss as an asset, as an administration. So the first item we need to find is our investment. So we go back to the question, we go and look for investment. So we see we've got 3% investments on the 1st of the 1st. We bought at the start of the year at 350,000. It's going to be 350,000 multiplied by 3%, and that's going to give our investment income. So 10,500, that's our investment income, and that's going to go to our profit and loss, and we're going to add that on to our operating income. Next we need to find is our investment income due. So of this 10,500 in the question, it said 3 months has been paid into our patents, or 4 months have been paid into our patents. So we've incorporated 4 months investment income into our patents. So of that 10,500, 4 months have been paid. So we'll multiply the 10,500 by 4/12. So we've paid 3,500. So what's left to pay then, or left to receive for our income, is the difference between the two. So we 7,000 is how much we need to receive from our investment income. So our yearly amount is 10,500. That's the investment that we're going to get for the year. We just calculated that. Of that 10,500, we have received 4 months of it, but we put it into our patents. So we're going to take the 3,500 out of the 10,500, and what's left then is this 7,000, and that's going to go into our balance sheet as a current asset. Remember, any income that's due, it's our money, so we need to record it as an asset. Now the next thing is patents. We need to take it out of patents. So to take it out of our patents, we're going to add it back on, and I'll explain that to you in 1 second. So with our patents, we're going to go back to the trial balance, and we'll see how much our patents are. So patents here, incorporating 4 months investment income, is 21,500. So 21,500. Now I said to you we're going to add the patents back on. So this one that's incorporated, we're going to add that on, 3,500. So we're going to add it on to take it out. So the reason for that is I'm going to show you the double entry for that. But our patents then are going to be 25,000. So our patents is an asset. Okay, so you look at the accounts here. Okay, and we know to increase an asset, we put it on the debit side. Our income is a credit. So to increase the income, we put it on the credit side. So what we need to do here is this income of 3,500 that should be in our income account, okay, goes on our credit side of 3,500. Now in our patents account, we're going to have 21,500 because that's how much our patents are. And now because we credited our income account, we need to debit our patents account of 3,500. So with this adjustment is nothing to do with adding and subtracting. This adjustment has got to do with debits and credits. It's got to do with patents are an asset. So to increase a patent, or to increase an asset, we know we stick it on the debit side, and an income is a credit, and to increase an income, we stick it on the credit side. So this 3,500 needs to be recorded in our income account. Because it's income, we're going to put this 3,500 credit side, and for every corresponding credit, there needs to be a debit, and the debit goes into our patents. So to remove it from our patents, we're going to add it on. So our patents then are going to be 25,000. Okay, so be careful with that. When we're taking our investment income out of our patents, we need to add it on. And the last part of it then is that the patents then, so patent is something that we have, so no one can copy our design. So this is going to be written off over a 5-year period. So after 5 years, that patent is not going to be worth anything to us. So we need to write that off each year. So we're going to find out how much do we need to reduce our patents by to go into our profit and loss account. So our patents are 25,000. And it says it's written off over a 5-year period. So what we need to do then is we need to divide it by 5. Make sure that 5 years. A 5-year period, yeah. So our patent's written off then 25,000 divided by 5. So that's going to be 5,000. So we're going to reduce our patents by 5,000 each year. And that's going to go into your profit and loss account. And it's going to go in as part of administration. And the last part then is because this is written off, we need to reduce our patents. So our patents 21,500. We're going to reduce by the written off period or figure, which is 5,000. So our new patents then is going to be 16,500, and that's going to go into your balance sheet as an intangible asset. So the 4 steps that you need to do for any patent incorporated is you're going to find how much your investment income is. You're going to find out how much your investment income due is. You're going to find what your patents are. And you're going to find out how much your patents written off are. So investment income, go to the trial balance, get to 350,000, multiply by 3%. So the total investment income we're going to receive is 10,500. So from investing that 3,500, we're going to receive an extra 10,500. That goes into your profit and loss and your operating income. You're going to add it on. Second thing, I usually do the investment income due here, just kind of keeping neat and tidy together. So of this 10,500, 4 months were incorporated as part of our patents. So we're going to take this 10,500, multiply by 4/12. That's going to give you 3,500. So what we've to receive then is this 7,000. That goes into balance sheet as a current asset. We got our patents then, so we need to take this 3,500 out of our patents by adding it on. Why do we add it on? Because of the double entry. So income is on the credit side, patents is an asset, so it's on the debit side. So the 3,500 goes on the credit side of the income account. The double entry then goes on the debit side of the patents account. That's why we're adding it on. Then we need to write off our patents. So each year we need to reduce our patents. So if our patents were 25,000, and each year we have it written off over a 5-year period, so each year we're going to reduce it by 5,000. So 5,000 is the expense for this year. That goes into the profit and loss as part of your administration. And then don't forget then to reduce your patents then by 5,000. So our patents at the end of this year are going to be worth 16,500. That's your balance sheet as an intangible asset. So that's how you do adjustment 2. The patents were incorporated. Or investment income was incorporated in your patents.